大家早上好今天其实没有直播计划，只是莫名其妙今天起得比较早，然后正好赶上 AFFIRM 的财报。我刚才看了一下它的财报，好像盘后有比较大的下跌现在看起来财报这个季度除了亏损多一点之外亏损它是有原因的好像主要是计提的跟亚马逊的那个 warrant， 然后其他的从收入角度增长40%不到，然后大家可能不满意的就是从整个它的生态链的增长上，比如说这个客户的就是 merchant 的增长，然后它的成本控制，这个季度我觉得还可以，然后生意上并没有明显的问题，然后它的平台上的消费者增长也很快。大家可能主要的问题在于，你看它收入的增长就是说这家公司本身就不是收入增长会特别快的公司，因为它本身是一个它是接在那些就是购物网站上这么一个支付的系统所以它不会每年有100%这样的增长，所以这种40%左右的增长，我觉得应该就算 OK。然后可能大家对它不满意的，可能是除了这个季度的亏损比较多，像刚才说它是一个一次性的计提，另外一个可能就是对后面整个全年的预期不如大家想的好，但这个可能要听管理层的一会儿我们听他的电话会议怎么解释。我的理解是，这种比较保守的估计，我们昨天其实讲了美联储的那个就是他加息的那个会议的详细的讨论的情况，我们把整个的那个他的那个会议的内容全部过了一下，有兴趣可以看一下。就你如果相信美联储未来的几个季度之内还是会持续加息就是比如说一直可能要到2023年的可能下半年才会开始，然后把利率把那个就是通胀控制之后，然后才开始减息。如果是未来至少半年以上都是一个加息的环境就他要逼着消费者，然后不要花钱，要逼着这听起来比较差，但其实是事实上他就是要更多的人失业，让更多的人花钱会更谨慎就是不要像现在这么大手大脚。然后这些情况当然对像 AFFIRM 就是对公司都不利就是不光是对它，但是对 AFFIRM 这样的平台，因为它本身是靠这种就是互联网的在线购物的平台是很重要的客户，如果消费者能力下降了这是对它的影响，是一方面的。另一方面呢，它其实因为它最终其实做的是贷款的生意只是它这个贷款是比较短期的，是先买后付，可能多数是几个星期的，所以就是效果比较容易能看得到。但是呢，即便是短期贷款，你也会考虑坏账的问题。所以如果是管理层认为未来几个季度经济会变差，那他必须要计提更多的坏账准备这我们期间银行都讲过了。所以那未来几个季度它可能会面临一个是增长上可能不像之前那么高就是刚才说第一个原因，因为整个可能那个平台的交易量就没那么多了，大家花钱没那么多。第二个，已经花的这部分包括他原先已经有的贷款，他可能要重新要考虑未来的还款是不是有些人会有问题，他要加提计提，所以它增长会相应放慢它的那个费用呢会相应提高所以呢，这种公司就是在如果是真正进入一个比较长的至少几个季度的经济衰退期的话从消费者的角度，对 AFFIRM 肯定会有，不管是增长还是对它的利润肯定会有影响但关键还是说到底是最后你看这个公司它的长期是什么样的东西就我个人感觉，长期要看这家公司还是要看它的平台整体的健康，就是说就是像这些大的像Amazon 也好，然后 Walmart、Shopify 这些大的平台是不是跟它会继续合作，然后跟它的那个合作是不是能够达到更深入的那种效果。第二个就是从它的角度，它面对消费者，它就两边的平台嘛，面对消费者那个平台上，它要推出它的那个借记加Debit Plus 那个卡是不是能够顺利推出？现在看管理层对这方面还没有太新的解释，所以 如果要考虑这家公司，这也是一个重要的，就如果它消费者那边如果能像 Square、Block 一样有很强的应用推出，让消费者然后很多人使用它的平台啊，就会增强它整个的这个生态链的话语权啊，因为它不光是一个支付的平台，它还能给这些在线的这些购物商可以带去很多的流量啊，因为他本身使用他的卡的人，他就可以给他更高的折扣嘛，所以我觉得这个整个生态链是不是在健康的发展啊，就是这些基本层的东西，我觉得是更重要的。短期的这个快一点慢一点，然后从利润上怎么样，这个我觉得不是太大的问题啊。当然得看它的成本控制怎么样。至少按照他现在发布的新闻稿来讲，就是管理层包括 CFO 还是确定说，他们要在2023年的会计年度啊，实现调整过的利润是实现正的，就基本上是说减掉股票那个新收费用之后，要达到会计盈利啊，这是他们之前就讲过的目标，他们这个目标还是没有变啊。我们现在听一下他的电话会议是不是开始了。
GAAP measures can be found in today's earnings press release, which is available on our investor relations website. Hosting today's call are Max Levchin, AFFIRM's founder and chief executive officer, and Michael Linford, AFFIRM's chief financial officer. With that, I'd like to turn the call over to Max to begin.
Thank you for joining us on this call. The fourth quarter capped off an exceptionally strong fiscal 22 for AFFIRM. We have once again posted a very healthy set of numbers, beating our own financial targets. We executed well throughout the quarter, meeting U.S. consumer spend where it was. With COVID restrictions nearly gone, getting out of the house and out of town became a huge draw. While homewares and fashion experienced something of a retreat to more normal levels of growth, we were able to help our longtime partners and online travel agencies have a banner quarter, posting triple-digit year-on-year growth in some cases. We had anticipated this shift a little while ago and recently announced some timely new partnerships in the space, like Agoda and SeatGeek. Despite what you may have heard elsewhere, people are still buying things online, a lot of them. Last month featured our very first Prime Day, which was as much a test of our product as it was of our systems and scalability, and we were quite pleased with the results. Running up to and during the event, we introduced zero APR programs on numerous SKUs. We also expanded our partnership with WooCommerce, which includes extending our reach to support their merchants in Canada. More recently, AFFIRM became BigCommerce's preferred pay-over-time partner, replacing a provider that specialized in the 6-week loan variety, underscoring merchant demand for complete solutions. And we significantly broadened our relationship with Stripe, unlocking streamlined distribution to more merchants and more consumers. We often talk about AFFIRM as a two-sided network of consumers and merchants. The less obvious but all-important third side is our capital partners. Maintaining a diverse set of funding sources is critical in this economic environment, and from our earliest days, we knew there was no winging it with capital markets. Today, we are proud to call some of the most sophisticated investors in the world our long-term partners. Thanks to our excellent capital team, we added just over $1.6 billion of net new committed capital. Approximately 70% of this capacity came from existing and new warehouse and forward flow agreements, including a new $500 million multi-year forward flow commitment. In addition, our capital team executed 2 new asset-backed securitizations during this quarter. As proud as we are of our results this year and quarter, we know that many people are thinking about how the economic picture may unfold, and so are we. The economy is more than likely in the beginning stages of a downturn. It's too early to tell how deep it will be and how long it will last. So how do we continue building the strongest AFFIRM amidst uncertainty? In a sentence, we are going to be cautious in our management of risk while investing aggressively in the expansion of our total addressable market. The former means our credit posture will remain conservative until we have a clearer view of the real economy. The latter is that we expect significant growth from new partnerships, new products, and new geographies. In the language of the 1990s internet, we're widening the top of our funnel while keeping a watchful eye on its bottom. Let me spend some time on both of these topics. As we have said numerous times in the past, credit performance is a non-negotiable guardrail for AFFIRM. This is true because we see guarding our consumers' financial health as a part of our mission, and because we remain obsessively focused on delivering exceptional results to our capital partners. We have both the underwriting technology and the control systems to deliver on this goal. We covered this in our May earnings call, but for a quick refresher, relatively short terms and individual loan approvals give us enormous flexibility when it comes to managing our back and front books respectively. Being able to request a transaction-specific down payment or additional income information and offer risk-appropriate term selection are just some of the powerful tools we have built over the years. This part probably does not need to be said, but just because there still seems to be some confusion, unlike the folks in the marketplace lending businesses, we are not dealing with the decaying performance of loans made years ago in pursuit of growth at all costs. Roughly half of our outstanding loan book is expected to pay down within 4 months or so, and about 80% within 8 months. Our mission and our business model compel us to keep our consumers' long-term financial interest in mind alongside our partners and our own. But while we expect to have a conservative mindset with respect to credit during this period, we intend to use our advantaged position to grow and to continue taking market share by expanding our total addressable market aggressively. Here are just some of the growth initiatives I'm excited about. Inclusive credit. We have worked relentlessly over the last several years to evolve our approach to identifying and underwriting creditworthy applicants left outside the traditional credit reporting infrastructure. By some estimates, this is almost 45 million Americans, and we are excited to begin deploying some of these features in time for the upcoming holiday season. Scaling brand-sponsored promotions. We continue to leverage unique features of the AFFIRM network, most importantly, SKU awareness. Through our brand-sponsored promotions product, manufacturers have the ability to sponsor low and zero APR deals at specific retailers on an item-by-item basis. Taking this concept a step further, we are delivering a full self-service console to participating brands and manufacturers to enable them to deploy promotions on the AFFIRM network seamlessly. International expansion. PayBright, now known as AFFIRM Canada, continues to deliver very good results, and I am pleased to announce that this past quarter, I asked Wayne Pauman, formerly the CEO of PayBright, to step up to lead all of our international efforts. Under his leadership, we are investing in the United Kingdom market this fiscal year and plan to continue from there. Debit Plus. We have spent significant time fine-tuning Debit Plus this quarter, focusing on the usability and profitability of the card. Transactions per active consumer are at a healthy 2.7 times per week, and the online-offline usage breakdown is split nearly evenly. It is still quite early, so as usual, a warning about reading too deeply into the fine-grained metrics. That said, GMV per active Debit Plus consumer is over 40% higher than a non-Debit Plus one, and after the first 2 weeks from consumer onboarding, we see near-perfect cohort retention. As you will hear in a second, we're still adding significant features to Debit Plus, and its at-scale contribution to our top and bottom lines is difficult to forecast. As a result, we have excluded all Debit Plus related metrics from our forecast today. We are excited by what we see in the usage so far and are committed to making Debit Plus a massive long-term success, expanding our reach, frequency, and profitability. Rewards. One of the key preference-driving features of modern consumer payments is rewards. It is the most common theoretical objection to BNPL versus credit cards. We can stop the debate. Our plan is to launch AFFIRM Rewards in beta this September with a number of participating retailers. As we roll the program out, AFFIRM consumers will begin to earn points on eligible point of sale, AFFIRM Anywhere, and Debit Plus transactions, with redemptions in the AFFIRM app. We're very excited about the possibilities here and expect to scale the program in time for the holidays. I'll stop here, but there are numerous other initiatives we're plowing away on while keeping credit performers top of mind. Last year, we hosted an event where we discussed our product roadmap in detail and plan to do one again late this year. We'll give you a much more detailed overview of what's getting built then. Before I hand it off to Michael, one more comment on growth. For quite some time, we've expected consolidation to begin in this space. Our exciting mission, market leadership, and a strong cash position make AFFIRM an exit of choice for teams with great talent, now that the prices in the parlance of our times have corrected a bit. We have no specific M&A targets to report today, but are keeping a very keen eye on the market. We continue to see strong demand for the simple idea of paying over time, and in particular for our take on it, supporting many transaction types and sizes and keeping away from gimmicks and hidden fees. Our strategy remains exactly the same as before, to continue building our network. More partners, more active consumers, and more transaction volume. As always, I want to thank the ever-growing worldwide band of AFFIRMers united by a shared sense of mission, and to send a special shout-out to the veterans, still going strong through the shared ups and downs of our first decade together. It's amazing to contemplate that just a few years ago, we imagined that supporting $50 million of transactional volume would be quite the achievement, even as we now plan our march to $50 billion of GMV just a few years from now. And now, on to Michael for the numbers.
Thanks, Max, and good afternoon, everyone. I'd like to start by echoing Max and acknowledging all AFFIRMers for their contributions and dedication to our mission. We are proud of the progress we made this fiscal year as we introduced nearly 7 million more people to Honest Finance, expanded and diversified our merchant base to cover more than 60% of U.S. e-commerce, and delivered very strong unit economics at 4.3% revenue less transaction cost as a percentage of GMV, well above our long-term range of 3 to 4%. With our team's solid execution, we exceeded all of our guidance for fiscal 22, despite increasingly volatile market conditions in the second half of the fiscal year. I'll cover 3 topics before we open the line for questions. First, a more detailed review of our fourth quarter results. Second, an update on what we are seeing in terms of consumer credit performance. And third, some perspectives on what we expect and how we plan to operate in fiscal 23, given the macro environment, the growth opportunities ahead of us, and the profitability targets we plan to achieve. Now to the quarter. Unless stated otherwise, all comparisons refer to our fourth quarter of fiscal 22 versus Q4 of fiscal 21. Our Q4 earnings supplement is also posted on our IR website. We continue to scale our network. Active consumers increased 96% year over year to 14 million, and active merchants increased to nearly 235,000. This helped drive 139% growth in transactions, 85% of which came from repeat consumers. As you have heard us say before, driving greater frequency is a key priority, as it not only fuels our flywheel, but helps us drive efficiencies. Annual transactions per user increased for the 4th consecutive quarter to 3 transactions per year, which was up 31% year over year. We grew GMV 77% and 89% excluding Peloton. Our strong traction across our enterprise partnerships continued throughout the quarter, with our 3 largest partners making up roughly 30% of our total Q4 volume. Our volume with our 2 largest partners grew 27% sequentially from Q3 and are still in the beginning stages of their integration. On slide 9 of the supplement, you can see just how diversified our network is across industries. This represents a key area of strength and resilience for AFFIRM, particularly as consumers shift spending patterns like they did in Q4. That said, given how underpenetrated we are today, our growth is not limited by the growth of our merchants or even broadly to e-commerce. For example, e-commerce penetration retreated to its pre-COVID trend line this quarter, and our growth still outpaced the broader market by an order of magnitude. Travel and ticketing increased to $545 million, up 87% from last year, and a staggering 443% compared to pre-pandemic levels of Q4 in 2019, highlighting the success of our investments and partnerships in the category. American Airlines, Expedia, Priceline, and Vrbo were all top 10 merchants for AFFIRM this quarter. General merchandise grew to over $881 million, 477% above last year, driven by our deepening relationships with Amazon, Walmart, Target, also top 10 merchants for AFFIRM in fiscal Q4. PayBright more than doubled, posting year-over-year GMV growth of 116%. PayBright continues to hold a market leadership position in Canada that includes merchant relationships with Apple, Samsung, and Hudson's Bay Company. Turning to the financials, total net revenue grew 39% to $364.1 million, above our outlook of $345 to $355 million, and grew 49% excluding Peloton. Network revenue grew 39% and interest income increased 33%. Gain on sale increased 30%. Revenue as a percentage of GMV contracted by 226 basis points to 8.3%, driven by a mix shift away from longer duration 0% loans and towards short-term split pay loans. Split pay GMV grew over 193% year-on-year and accounted for roughly 23% of GMV in the fourth quarter compared to 14% last year, as you can see on slide 8 of our earnings supplement. Split pay has a different economic profile compared to our core 0% APR program, and the composition of these two products effectively reversed year-over-year as we have expanded into higher frequency transactions. This resulted in a year-over-year decline in revenue take rates, which we express as a percentage of GMV. However, you can see on slide 14 that take rates within each of our product offerings continue to remain relatively stable. Our strong top-line growth, combined with the leverage we achieved on non-provision transaction costs, drove a 25% increase in revenue less transaction costs to $184.3 million, or 4.2% of GMV. Total transaction costs of $179.8 million grew 58% year-over-year. Excluding provision expense, transaction costs grew 21% compared to revenue growth of 39%. Loss on loan purchase commitments declined 21%, primarily driven by the mix shift I just mentioned. As a reminder, loss on loan purchase commitment mainly occurs with the core long-term 0% APR loans. Our funding costs increased 24% year-over-year, in line with the 24% growth in loans held for investment, despite the higher rate environment, and significantly below the 53% growth in our total platform portfolio. On our February call, we estimated that a 100 basis point rate increase beyond the forward curve at the time would result in an approximate 10 to 20 basis point impact to RLTC as a percentage of GMV for the second half of fiscal 22, based on our mix at the time. Since February, peak rate expectations within the forward curve increased by more than 150 basis points. Despite this, we delivered 4.4% RLTC as a percentage of GMV for the second half of fiscal 22, well above our implied 3.9% in our outlook at the time. We have the ability to manage the short-term impacts in the forward curve with the tools inherent in our product, which Max shared moments ago, and staggered renewal periods on our funding facilities. We continue to estimate that a 100 basis point rate increase beyond the current forward curve may translate to an approximate 10 to 20 basis point impact to RLTC as a percentage of GMV in fiscal 23. In comparison to a more normalized fiscal third quarter of 22, provision for credit losses grew just 10%, and provision expense as a percentage of GMV declined by 4 basis points sequentially to 1.65%. Our allowance for losses as a percentage of loans held for investment declined for the third consecutive quarter to 6.2% as we continue to drive strong credit performance. Excluding transaction costs, non-GAAP operating expense grew 60% to $215.2 million, or 59% of total revenue. On a non-GAAP basis, sales and marketing expense declined 1% year-over-year. Adjusted operating loss was $29.3 million in the quarter, or 8% of revenue, which was significantly better than our outlook for adjusted operating loss of 15 to 11% in the period, driven by better than expected RLTC and lower than expected operating expenses. GAAP total operating expenses, excluding transaction costs, grew by 76% to $461.6 million, driven by year-over-year growth in enterprise warrant and share-based expense of $102.7 million. GAAP operating loss was $277.2 million, which compares to a loss of $114.3 million in the prior year period. Now, to move on to my second topic, consumer credit performance. We believe we managed this to a great outcome despite the environment. As we have shared in the past, we are first and foremost focused on managing risk. We constantly monitor the credit performance of our portfolio as well as the broader environment. Given inflationary pressures, we began to see the signs of stress during the quarter within certain low credit segment consumers. This stress, without mitigation, would flow through to charge-offs. However, the inherent advantages of our underwriting every application at the transaction level and the high turnover nature of our book provides natural agility. Accordingly, we ever so subtly turned our dials and gave up a couple of points of growth this past quarter through small optimizations. and we still grew GMV by 77%. When we say we have the ability to manage credit outcomes, this is exactly what we mean. Our delinquency levels are healthy for our business, and we have demonstrated our ability to grow while controlling them. We've said it before and we'll say it again. We are different from our competitors who had to dramatically slow their growth rates because this is the only lever they have for managing risk. We are confident that these differences will only become more apparent over time. With that, let me turn now to our outlook for fiscal 23. When we reported our fiscal 21 results a year ago, we had just posted $8.3 billion in GMV. We closed fiscal 22 well ahead of our plan at nearly $15.5 billion in GMV, representing 87% growth in GMV and 114% excluding Peloton. Our team's outperformance this year means we are ahead of where we expected to be in terms of market share. We believe that we are well positioned to continue growing our network while expanding our product offerings and geographic reach. That said, we think it is important to acknowledge the current macroeconomic backdrop as we give our initial guidance for fiscal 23 and attempt to estimate these factors through June of next year. While we cannot precisely predict the macroeconomic conditions, our outlook assumes the current forward interest rate curve. It also assumes that the current macroeconomic conditions do not fundamentally change for the better, with early signs of consumer stress persisting through the fiscal year. If we do see signs of significantly more stress, or if rates were to increase much more than expected, we expect to utilize the various levers at our disposal to protect our unit economics. Among others, these include merchant and consumer pricing, duration shortening, approval rate changes, and down payment rates. Our outlook is also informed by the following. First, we made significant progress within our Shopify and Amazon programs, which reached general availability in June and November of 21, respectively. As we enter the second year of availability for each of these programs, we expect continued growth in fiscal 23, albeit from a much bigger base. Similar to fiscal 22, we expect holiday-driven seasonal GMV strength in the second quarter of fiscal 23. However, we are forecasting the second quarter to be the low point for the year-over-year GMV growth, given the nearly 370% growth in general merchandise GMV that we are comping against. Further, given timing within the quarter and the product mix, we expect to see a seasonal decline in both revenue and revenue less transaction costs as a percentage of GMV in the period due to how revenue is earned on these loans, similar to last year. While we continue to make progress with Debit Plus, we are still in the early innings. As such, our outlook for fiscal year 23 does not include any material GMV or revenue impact from this product. While the funding markets remain volatile, we enjoy a strong position without any current concerns on funding our growth. We would expect to continue to execute across all of our funding strategies and keep equity capital required below 5% of total platform portfolio. At that level, this would reflect marginally less ABS execution proportionally this year. With that context in mind, for our fiscal year ending June 30, 2023, we expect gross merchandise volume to increase between 32 and 42% from fiscal year 22 to between $20.5 to $22 billion. This would imply a 2-year compound annual growth rate of between 57 and 63% versus fiscal 21. Accordingly, we expect revenue of $1.625 to $1.725 billion, representing year-over-year growth of 20 to 28%, and a 2-year compound annual growth rate of between 37 and 41%. The forecasted contraction in total revenue as a percentage of GMV in fiscal 23 is partially driven by our aforementioned interest rate expectations and the continued mix shift to expand into higher frequency purchases. Turning to expenses. We expect transaction costs of $865 to $915 million, reflecting a modest year-over-year reduction in transaction costs as a percentage of GMV. This improvement is expected to be driven primarily with the loss on loan purchase commitment line. As a result, we expect revenue less transaction costs of $760 to $810 million. Revenue less transaction costs as a percentage of GMV is expected to be roughly 3.7%, in line with our long-term model of 3 to 4% of GMV. Moving down the P&L, while we will be prudent with expenses to be reflective of the current environment, we will continue to invest in engineering and product talent to support the robust product roadmap that has been and will continue to be a key differentiator for Affirm. We expect our sales and marketing and G&A expense lines to grow on a dollar basis in the year. However, these lines should demonstrate operating leverage as a percentage of revenue when measured on an adjusted non-GAAP basis. Accordingly, we expect adjusted operating loss as a percentage of revenue of 6.5% to 4.5% for the full year. As we shared in our May earnings call, we expect to achieve a sustained profitability run rate on an adjusted operating income basis by the end of this fiscal year. As we said previously, we do not expect to compromise our long-term growth opportunities as we progress towards sustained profitability. Finally, we expect weighted average shares of approximately 298 million for the year. For our first quarter ending September 30, 2022, we expect GMV to grow 55 to 62% to $4.2 to $4.4 billion. We expect that growth to drive total revenue of $345 to $365 million. Our outlook for the first quarter also contemplates transaction costs of $176 to $188 million. Revenue less transaction costs of $169 to $177 million. Adjusted operating loss as a percentage of revenue of 12 to 10%, and weighted average shares outstanding of 292 million. While the uncertain macro picture over the next 10 to 11 months, as well as us lapping some staggering year-over-year comps, are leading us to be prudent in the short term, we remain very bullish about our opportunities. We are confident in our ability to execute, and we continue to see strong underlying trends that position Affirm for further growth and success. With that, we'll open it up for questions. Operator?
Okay.
Thank you. We'll now be conducting a question and answer session. We ask you please ask one question, one follow-up, then return to the queue. If you'd like to be placed in the question queue, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you'd like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing star 1. And once again, that's one question, one follow-up, and please return to the queue. Our first question is coming from Ramsey El-Assal from Barclays. Your line is now live.
Hi, thanks for taking my questions this afternoon. I wanted to first ask about the July and August delinquencies. Should we think about an ongoing increase as we move forward, sort of a similar magnitude this year, or can you adjust your credit box, as you kind of mentioned, to sort of engineer more of a plateau there? I guess an easier way to ask the question is, what provisions and losses are baked into the full year guide? Maybe that's the way I should have characterized it.
Thanks for the question, and I'll start, and Michael can help quantify it. So probably the most important headline is that we are in full control. You should start seeing what we mean by that relatively quickly. One good metric, or one sort of anecdote to offer. So we have been taking a fairly conservative posture, and as you hopefully heard on the call or in the pre-recorded part of the call, we have been keeping an extremely careful eye on the credit performance. All the while, our approval rates have actually gone up. So what we've been doing in the background, and not a lot. It sounds like we've opened up the funnel significantly. I think the 3 points of incremental approvals have been added. What that means, though, is that we've been optimizing credit very, very actively. This implies things like tightening in durations, asking for a significantly more down payment in some cases, asking for incremental income information. So, yes, I don't think you should expect us to increase our provision. In fact, we intend to, if anything, be quite conservative. I know Michael want to quantify it first.
No, just look, I think what you're seeing very recently in terms of the sequential build is what we consider to be a pretty normal seasonal pattern. That seasonal pattern should begin to abate and go down. As you know, there's 2 things to think about. There's the numerator and the denominator. The one thing to keep in mind is that obviously is the base that you divide it by, both in terms of the impact that we have on total term lengths as well as what we have just in terms of the actual change in the total portfolio. We'll change the measure that we report publicly, but when we look at the business and think about the state of credit, we feel very optimistic that we have it well in hand. And the ultimate proof is how that shows up in our confidence around our margins in the business, which we continue to believe are quite strong and on the higher end of our long-term range that we've given everybody.
Got it. Okay, thank you. One follow-up from me. Could you give us a progress report on the Amazon ramp and maybe focusing particularly on Prime Day? How did that go for you? I think it's a new input into the model this year. Did the 0% loans gain traction? And could you see a scenario where that has become a more permanent fixture at Amazon?
So probably the most important thing to know about Amazon is that it's still very, very early relative to the potential of just the sheer scale they have and the many different ways for us to work together. We were very pleased with our Prime Day performance, frankly, as much technically and just ability to approve and ability to scale all the I think from underwriting to the web systems. All that went really, really well, and our partners have given us high marks on that front. We have a lot of work to do. You're right that the 0% is always a extreme crowd pleaser when it comes to consumer buying, and I think both of us in a partnership have noticed that it is in fact a very successful way of offering consumers a reason to buy now. And so we expect more of that, and as it happens, we'll certainly report on it. But the current state of the partnership is, nothing but excellent.
Thank you. Our next question is coming from Dan Perlin from RBC Capital Markets. Your line is now live.
Thanks. Good evening, everyone. I wanted to just touch base on the transaction cost ramp. It looks like you gave us the first quarter and the full year, so it looks like it's going to pretty materially ramp as you go out into the back half of the year, especially with your commentary around some leverage on loss on loan purchase commitments, which totally makes sense. So I'm just trying to understand, I guess, a couple of the major drivers. You just mentioned that your provisioning didn't sound like it was going to be off the charts, although I suspect that has to be higher. And then your funding costs obviously have to be up based on the yield curve. So maybe you could just help us walk through the cadence a little bit of that and maybe some of the line items that we need to make sure we're really focused on there.
Yeah, I think one of maybe the most important things to think about is the seasonality that we would expect around both the revenue and transaction costs. Q2 is going to see, we think a valley both in terms of the growth rate of the business, the revenue take rate, and the revenue less transaction costs. And that has a lot more to do with the timing and type of loans that originated, much like it did last year. In the back half of the year, we would not expect any material changes with respect to the efficiency, except we actually would assume it improves on a margin basis from Q2 onward.
Oh, okay. And then, you sound decidedly more conservative and maybe concerned about the macro and the consumer on this call relative to maybe previous calls, rightfully so. But how do we think about how big maybe that cohort is when you're talking about, lower credit quality, seeing signs of stress? Is there any way you can size that for us or just give us some context about, what that looks like inside of your overall portfolio? Thank you.
Yeah. The answer that we've been giving folks up until this quarter is that we saw, quote, no signs of stress. And that was something that was the first quarter we saw any signs. I think what you saw, though, in the quarter was all of our tools to manage that on full display. The reality is we saw the stress and we began to have to react to it. So I don't know that we're making a statement about things into the future beyond that. What we saw today is extremely manageable, and that's just not the case for other lenders out there right now in these credit segments. We're trying to differentiate us is that we actually have the leverage to control it, and we did. And we continue to feel very good about being able to do that into the future. The statement around a macro environment really should be heard as uncertainty. I would politely challenge anybody who thinks they can predict where the economy is going to be in 10 or 11 months. And I think that gives us reason to be prudent in how we operate the business. Given the lead that we built, we have the ability to be very careful and thoughtful about how we run the business. And it doesn't show up in, as Max said, it doesn't show up in us, throttling approval rates substantially. shows up maybe in the timing and type of products that we might want to launch, and being careful about introducing a lot of net new because we don't feel like we need to right now. We can be very careful and thoughtful about the state of the consumer and play with the lead that we have right now.
Thank you. Next question is coming from James Fawcett from Morgan Stanley. Your line is now live.
Thank you. I want to just ask a clarifying question on the rising delinquencies. I mean, it seems like, they're kind of, at least in the last month or 6 weeks, or a little outside of where you've historically targeted. Are you saying that, through the incremental changes in the way that you're managing that, we should expect those to come back towards that 2%, or what's kind of the right range for us to think about where those should be at? And I guess along with that, are there adjustments you need to be making to your provisioning? And then I have a follow-up question on funding.
Yeah, so let me start with the second question first. Our allowance that we have on the balance sheet, which determines the provision in the income statement, is that for the third quarter declined. So we have, I can't find any other words to describe how comfortable we are with the current state of credit, other than we provided for a full expectation of credit losses at the time of origination, and that outlook has been improving for the third consecutive quarter. So we feel very strong about the state of the portfolio. The delinquency data that we show publicly is the portion of the total platform portfolio that's 30 days delinquent or more. And as I was probably mumbling through a little bit earlier, there's a numerator and denominator effect there. And so it's a little bit difficult for us to want to be prescriptive on where that number needs to be. Obviously, we have a guardrail. We're way away from the guardrail. The guardrail, as we talked about earlier this year, is many points above anything that we've ever operated the business at. The real thing we would like to do is make sure that the unit economics, our revenue less transaction costs, are still printing at really high levels with the provisions that we would need to be taking. And those are the numbers that we feel really, really strong about. And on top of all that, we are hitting the seasonal peak for delinquencies, and therefore would expect the seasonality trend to work into our favor from here.
Got it. And then on funding capacity, appreciate the update there. Can you help characterize for us what the nature of those commitments are from a capacity standpoint, and anything that we should be aware of, either in terms of upcoming renewals or where the way terms of those commitments could change, et cetera? Thanks.
Yeah, thank you for the question. So first, just overall, a way to think about the market, we have really strong demand or supply for on-balance sheet warehouse capacity. I would characterize it as us having to say no, and the banks are plenty willing to lend money right now. I think the forward flow market also remains very attractive with a robust pipeline of forward flow buyers who are interested in partnering with us. I think the ABS market is obviously quite volatile, and you're going to see us be a little bit more careful and thoughtful about where and when we execute there this year. However, with respect to forward flow, that capital is very committed, and we have about $200 million out of $4.3 billion of forward flow capacity that's even up for renewal in the entire fiscal year. That is to say, 95% of our capacity is mostly locked in through the entirety of fiscal 23 on the forward flow side. What that does for us is it serves as one of the many tools that we have to mitigate any impact of rates. So the ways that rates could impact us are, first and foremost, access to credit. We enjoy a large amount of capacity where it will not constrain growth. And the second way it impacts us is obviously in higher cost of funds or lower yields that we're able to get when we sell loans. In both those cases, those impacts are delayed. What you saw in the back half of fiscal 22 was a huge shock in rates. When we talked in February till the end of the year, peak rates moved, as I said in my note, over 150 bips. And the impact to us was frankly impossible for anybody to see, as we crushed our revenue less transaction cost numbers in that period. So we look at next year as being, a very secure and safe level of funding, with the upside being our team is still out executing deals because the markets are still very constructive on the forward flow side. I think the one thing that you're going to see less of this year, though, is ABS execution, with the big caveat being we just don't know. I mean, if the market does find a new stable footing, you'll see us be active in the back half of the year. But as we sit here today, we do think that there's a lot more volatility in that market. We're going to be, and that's showing up in how we're talking about the funding mix for the next year.
Thank you. Our next question is coming from Jason Kupferberg from Bank of America. Your line is now live.
Hey, thanks, guys. I just wanted to start with a two-part question on GMV. Can you tell us the fiscal 23, the GMV growth guidance ex Peloton, and then just the second piece there is, if we reflect back on fiscal 22, I think you had started the year guiding to 50 to 54%. You ended up at 87. The Amazon helped, and so I'm just trying to get a sense of, how much conservatism you guys might be trying to bake in. Just as you've highlighted multiple times, there's a lot of uncertainty out there. And then I have a follow-up. Thank you.
Yeah. So the first question in terms of Peloton, we're very proud that we've expanded our merchant and category mix, where Peloton continues to deconcentrate in our business. It was low single digits % of our business in Q4, for example, and yet we still haven't lapped all of the contribution. So we would continue to expect that to be a declining business. Our current expectations are that it's something on the order of 4 points of GMV growth and 7 to 8 points of revenue growth that we are not getting this year, or at least that we expect Peloton to drag against. And that's part of the reason why we're so confident in the long term here, is that we do have to grow out of this little bit of a drag associated with a partner who's trying to right a troubled ship. The second question was how much conservatism we have. And look, our guide is our guide. We are not going to caveat it or characterize it in any way except it's our guide. However, we do take it very seriously. We like to put numbers out there that we can achieve. You'll notice that the ranges are wider this year. The width of the range reflects the fact that we do have a lot more factors at play that we can't control. But our guide is the guide, and yet we take it very seriously, and I don't think we've missed one yet.
That is true. Just to follow up, I guess on the credit side, I mean, as we talked about, the delinquencies are up a little bit. I think charge-offs were up as well, but looks like there was actually a little bit of reserve release in the quarter. As you mentioned, the allowance ratio was down again. So can you just help us reconcile all of that? I guess, just given what's going on in the macro.
Yeah, so maybe a little bit of brief description of how the allowance and provisioning works mechanically. So at the time of origination, we make an estimate of the likely allowance needed for that loan, and then every month we update what we would consider to be the back book's drift or improvement. And so, for example, we might estimate a loan or a pool of loans would have a 5% total loss content at time of origination, and a month later, depending upon actual repayment information or the flow rates from one delinquency bucket to the other, we update that view. And it is the case that we're outperforming our own expectations. And just generally speaking, we like to try to be pretty thoughtful in ensuring that we're never under provided for potential losses. That's the right side of the ledger to be on as far as we're concerned. And I think that's a factor that's probably very difficult for you to read through, which is why we keep pointing people back to look at our current allowance rate, and that is our current estimate of all of the future losses of the loans that are then on our balance sheet. I think that drawing a straight line between data like the DQ30 chart to eventual charge-off is a pretty big step, and probably not something that I would do. I would look to the current allowance rate as the total losses for the book that's on the balance sheet, and then think about that number as being increasing or decreasing consistent with the future expectation of losses.
Thank you. Our next question today is coming from Moshe Orenbuch from Credit Suisse. Your line is now live.
Great, thanks. Michael, I think you partially answered this in one of your earlier comments, but could you talk a little more about the credit tightening steps that you took and what impacts they have on the GMV in fiscal 23?
Yeah, so I think let me speak to what happened in the prior quarter first, because I think that's pretty illustrative of what we think will happen. We might look at a particular merchant or set of consumers or products. We're able to be very surgical, and we'll find a pocket of risk that, say, is currently experiencing signs of distress. The levers then that we have at our disposal are everything from actually just increasing the credit bar, so lower approval rates because you have less of the capacity to approve, to changing the term lengths. If you change from a 24 to 18 months, your risk posture changes, or requiring more down payments. Max mentioned this at the very top. We made all of those moves to manage the early sign of distress. Those are signs of distress I think you've seen reported in a lot of other contexts. We were able to fully mitigate those and still be very thoughtful and actually increase our approval rates. And that's because approval rate, yes or no, isn't the only lever that we have. We have a lot more tools at our disposal. And we could be very growthful because we were still launching and scaling these very large platform relationships like with Amazon and Shopify. And so these, I would characterize them as truly, like we're talking about low single-digit percentages of GMV on a net basis, because while we're doing those tightenings, we're also doing optimizations that open up and find opportunities to underwrite really good risk. If you think about how that informs the plan going forward, I think it's maybe a tertiary factor. I don't even think it's a primary factor. And it's definitely true that we have a more conservative posture today than we did a year ago. But the impact of lapping the explosive growth in the first half of last fiscal year and the aforementioned Peloton categorical headwind, combined with the things like the shift in e-commerce and discretionary spend, those probably matter more than the things that we're seeing directly on credit as we sit here today. The truth is, as we said in the call, if we see deterioration, we will pull extra levers. They may not show up as substantially less growth, but they will nonetheless show up with protecting our unit economics.
Got it. Thank you. And as a follow-up, at the beginning of the call, Max had mentioned the rewards program. I was hoping you could kind of maybe flesh out a little bit how you think that will impact both sides of revenue less transaction costs, how it'll impact, kind of volume and costs as we go forward.
So first of all, we're launching a beta, and as we do everything here, it's a slow start, very careful optimization. We're not going to compromise our unit economics. We're not going to compromise any other metric that we care a lot about. The goal is, first and foremost, is to compel consumers to transact with Affirm more. I think when we took this company public, the conversation in the investor community and the analyst community was, well, you guys are great, but will people transact more than just 1.5 times a year or whatever the number was? We've shown that we can continue to move that number up and up and up. One of the preference drivers is how rewarding are these transactions, and typically that means miles or points or something like that. And of course, we'll put our own spin on it, and we are different, and we like our differences. But it will be a way to give consumers one more reason to choose Affirm when they have all the choices. Rewards also tends to attract higher credit quality consumers. Just as a general statement, you will see that folks that need credit to improve their buying capacity don't care as much about rewards. Folks that have lots of choices tend to select their paying instrument in part based on how rewarding it is. Therefore, consciously, and we're being very careful in the forecast here, with that peace in mind, we don't expect to make these cost us more in unit economics. The goal is to keep the unit economics what they are, protect them. We quite like our LTC rate, and we'll keep targeting that. That hopefully makes it clear that these are predominantly merchant funded. We'll launch with a handful of early merchant partners in just a little while from now, and we'll see how it goes and how well it drives incrementality to GMV. So the simple answer is we expect more GMV, hopefully more transactions per active user. Should not expect deterioration in unit economics.
Thank you. Next question is coming from Rob Wildhack from Autonomous. Your line is now live.
Hi, guys.
Hey.
I wanted to drill down a bit on the revenue outlook. As a percentage of volume, revenue this year was 8.7%, and the midpoint of the guidance is for 7.9%. So what else besides Peloton, if anything, is moving around in there?
Yeah, Peloton, and in general, the mix shift towards lower take rate products. And if you think about a dollar of, low teens MDR, high long-term 0% being swapped in for a dollar of, 4 to 5% split pay type MDRs, you're giving up a lot on a GMV basis in terms of total revenue. Now, some of that's offset by the strong revenue profile of our interest-bearing product, although there's obviously a timing element to that as well. But the biggest driver is just the growth in our low AOV business, which has a lower revenue take rate.
Okay, thanks. And then on Debit Plus, I appreciate that it's still early, but now that that's generally available, how do the unit economics there compare to the 3 to 4% revenue less transaction cost yield that you're always talking about and emphasizing? And would growth in that product have any material effect on the target for adjusted operating profit to be positive by year end?
It's a great question. The short answer is too early to tell. The reason we excluded the forecast is because that's literally what I've been spending a lot of my personal time on, and I'm not prepared to declare it to be ready to be given to everyone. We have 14 million active users that are very excited about this product. It's very clear that they're transacting a lot more. If you drill down in that, you'll see the metrics that there's quite a lot of pay now transactions. Those obviously have a very different revenue profile. There's not a lot of risk in there at all. And that's obviously a natural drag on revenue less transaction costs if you start thinking of it that way. On the flip side, we see quite a lot more loan volume, which is great, and we're excited about the incremental usage that we get in the credit that we provide there. Again, our goals are very clear. We very much like our unit economics. We intend to protect them. We're not going to compromise them. The risk associated with these transactions is new to us. We're still optimizing exactly, for example, what sort of insufficient funds rate we'll see as the transactions flow through to connect to checking accounts. That's why we haven't pushed it all the way through to the general population. It is available, but we have really not promoted it very hard. So I think I've given just enough data before.
Yeah, and the thing I would maybe to put it in context, the revenue models for the Debit Plus product will be unregulated today. It's unregulated debit interchange, which obviously you're not making 3 to 4% when your gross is down there, and then interest bearing. I'll just note that some of our strongest and most profitable programs are direct to consumer interest bearing products. We feel really good about that side of the house, and obviously you'll see some lower total growth and net take rates, revenue take rates, and our RLTC take rates on the pay now or debit transactions that happen on the card. We've not given any guidance because, as Max said, it's a bit too early, but you would expect it to be lower. That being said, our direct-to-consumer product is much higher than that, and so we haven't given guidance and not going to today, but we feel really good about where we'll get to once we are at scale.
OK， 小孩要起床了，所以我们这个直播基本上到这儿。简单讲一下我的看法啊，就是我会今天晚上可能会出一集视频，然后等我有时间仔细再看一下他的财报啊，以及重新再听1、2遍他的电话会议。我总体的感觉是没有特别然后出乎意料的东西啊，就是这个季度的财报跟上个季度相比，唯一的比较大的变化就是他们可能像比如 Upstart 其实表示也是一样，就是说现在已经开始看到有一些消费者出现了这种 stress 啊，就是说确实这个坏账有所增加，所以呢他们也开始就是公司开始行动，然后降低自己的风险，包括比如原先可能期限比较长的贷款，现在可能缩短期限，然后原先可能比如说就是有些给的，现在可能就不给了，所以这是从他的行动当中表示控制风险。 然后但是好处可能在几个，就是说比原先想的要好的。第一个就是它的 funding， 它的资金的来源，它是讲说，因为它 ABS 市场这个大家都是一样的，就是这个波动很大，所以他们也不好说后面会怎么样。但是它主要依赖的是那个叫我们之前讲过 forward flow 啊，就是说别人买了之后，然后再卖到机构。所以这些呢，他说它的95%的这些基金啊是在2023年它的财年度是已经锁定了，所以它就是只有大概5%。这中间的这个资金，它需要重新跟这些资金的提供方来商量一个新的条款，所以呢，商量新的条款可能多数的情况下就会提高的那个成本啊，但是95%它不需要，就是在1年之内这些资金是稳定的。然后第二个就是说，它虽然是看到那个消费者的情况略微有所下降。但是呢，它之前的就是算法，因为它这个我之前讲过，它的所有的就是80%的这些贷款呢，就是在几个月之内就到期了，所以他当时给贷款的时候，只要给的比较保守，这个其实贷款的这种坏账率不见得会很差，所以管理层就确认，他说我们之前已经给出去的贷款，他对这些的预期其实在过去4个季度是在变好的过去3个季度在变好的。而且它现在虽然表示上从财报上看，那个你看它最新的这个季度，那个 Delinquencies 就是交款变迟的这些客户有2%以上有个上升，但它是这个其实是跟季节性有关系，然后到了下半年可能就会有所好转所以总体来讲的话，不觉得它在坏账上有从现在看存在多大的风险。从另外一些角度，比如说公司基本面来讲，然后有很多新的伙伴，然后而且他的管理层对整体长期仍然很有信心他的那个 CEO 讲说，他们有可能会看一些并购的机会，然后因为现在他的那些竞争对手很多那个价值已经下降很多，所以他可能可以通过一部分现金再加一部分股票，可以以比较便宜的价格，然后扩大自己的生意，然后。不太清楚的就是他没有像最后一个问题也是问他那个 Debit Plus 那个信用卡的进展，但是管理层现在给的信息还是很少，所以呢，他就是最终的这个所谓的双边的这个网络这个能不能建成，有多么健康，这个现在还不太好说，所以这是要确定的。所以总体来讲的话，这些多数的情况跟预想的差不多我觉得大家。可能是这种股价的涨落，就反映了其实市场对它之前的预期可能是比现在听到的要更好一些但是这种预期可能是跟之前管理层觉得总体它的坏账没有问题，以及对市场比较乐观有关所以这个季度确实至少管理层的角度说，跟之前就是从那个语气上对未来的经济至少是不像之前那么乐观了这也可以理解。所以我可能今天晚上或者是在比如周日会员直播的时候会再讲一下新的东西。然后我们现在就到这样了，因为小孩要准备起床，然后上学了，好吧？谢谢大家，早上好，再见。视频不是投资建议，再见。